Hey everyone, it's Imran back with another macro option spotlight for you. All right, what's going on in markets? I've been looking at various macro charts. A couple stood out to me recently. Obviously, we've been going on about market breadth, deteriorating, very narrow group of stocks that have led this advance in markets recently. Obviously, the whole AI explosion. But looking at other assets, whilst we are seeing cross-asset volatility falling everywhere, so equities, FX, bonds, commodities, vols going down pretty much across the board. Normally, you would see credit rally quite hard with that. So you'd expect credit spreads to come in and you expect to see the likes of HYG rallying. Now, if we look at the chart, HYG versus S&P, those two tend to track each other quite well. So we go back to 2021, right? Quite a strong connection between these things and the swings that they have. We've now got quite a big divergence, quite a big gap forming between the SPY and HYG. Now, clearly, some of that has got to do with this AI outperformance and these mega cap tech stocks that are such large weightings in the S&P that have been rallying. But in general, we have been flagging that HYG seems like it might be due a move here, breaking out of a bit of a triangle. It hasn't quite broken it yet, but it's threatening to break it on the upside. And if it was to break it on the upside, then there's a bit of a catch-up move here. I don't think we quite go all the way to 80, but we could easily go towards halfway, somewhere between 76 and 77 on HYG, which, given that HYG trades on a 6 handle in terms of vol, is quite a decent move. So that's just something we need to be aware of. Now, clearly, if the banking crisis comes back on the radar over the summer, then that might put a spanner in the works for any rally in HYG. But all things being equal, we do see this as a potential move that could occur over the summer. Now, China has obviously been struggling with its reopening. The macro data keeps disappointing there. They've obviously started to, potentially look at stimulus again. But if we look at economic surprises in Europe as well, via this CESI Europe, that has really rolled over quite sharply. That's the orange line. And again, to some extent, you'd expect European stocks to be tracking this. If the European economy really is disappointing to such an extent. We have started to see the euro-dollar cross move down as the dollar has bounced. Euro-dollar's come down from like 110 to 107. So that is moving in sympathy, but these stocks just don't want to go down right now in Europe. So we do think these stocks could be vulnerable to a re-rating lower, and this whole US exceptionalism theme is coming back in terms of people crowding into US tech again, because that's where the growth is, that's where the innovation is. And whilst they crowded a bit into European stocks at the start of the year, on the back of largely the China reopening, that may need to get somewhat unwound. So just something to be aware of. So those are two big macro sort of themes and charts that we've noticed. Okay, moving on to our vol dashboard. At yesterday's price action, we did see stocks pull back a little bit from intraday highs. Apple released their new augmented reality headset, pretty steep, about $3,500 a pop. So they're trying to compete with the likes of Meta and their Oculus product, but the price point is pretty high, which means it's going to be hard for that product to hit mass market. The stock wasn't overly impressed. It popped 2%, finished down on the day, taking general markets back down with it. So not an amazing performance for that sort of launch that they've been working on, I think, for quite some time, even though the product apparently is very nice and very good and slick and pretty much shits all over the other equivalent products from the likes of Meta. The point is it's very expensive. Okay, so we're not quite sure how much that's going to improve Apple's revenues and how much adoption that's going to get. Outside of that, commodities were stable to firmer. Oil giving back the OPEC post-OPEC rally that really didn't last very long at all. The dollar's hovering around 104 on DXY still, but in FX land, kind of the Aussie pop overnight is probably the main thing, as they surprise hike 25 basis points, taking the Aussie dollar up to key resistance. Bonds were drifting slightly yesterday as well, but nothing big. And then looking at sectors, ARK once again outperforming. And that's really starting to put in some very good gains, 7.5% just week on week. Looking at vols stabilizing after the rout last week. So we're seeing sort of 20 bips to half a vol higher across major US indices. Nikkei vols was the big one. That popped 2 points as we saw Nikkei spot up at 2% again, taking out the highs And we're seeing vol kind of doing its usual rallying with spot in Nikkei. That correlation seems to be quite strong right now as we keep making new highs. Energy vols did come in about 3 points. Obviously, they were up pretty heavy last week, up 4 on the week, giving back 3/4 of that in just one day, as spot not doing a whole lot. Metals vols pretty muted though. FX vols had a small uptick, even though the moves were quite calm. Same with bonds. Bonds vols stabilizing, but not really seeing huge moves. Carry still showing very negative. If you look here, there's a lot of red, basically suggesting that options are worth owning right now. And given that we've got some catalysts coming next week in the likes of CPI in the US on the 13th, so it'll be on Tuesday, and then on Wednesday we've got FOMC. It doesn't seem like you want to be smashing out vol at these levels, given historic realized and potential for movement next week. So that's kind of the basic takeaway. And then lastly, skew, seeing a little bit of a bounce in skew in terms of the S&P. But in general, outside of that, we saw a bit of a bounce in skew in uranium, nat gas and oil as well. And then bond skew also picking up a little bit after getting hit quite hard last week. All right, that is it in terms of the summary. Moving on, we are looking at ARK right now. So just screening across all our dashboard, trying to identify trading opportunities, what we're seeing. So we know that tech stocks had a great run. It's been fueled by optimism around AI. Obviously, blowout guidance from NVIDIA really got things going. The ARK basket itself has started to participate in the upside. We were looking for that break of 40.5 and we got it. Now, it may well have legs to go. And it, highs that we saw back in February could take it all the way to 45. But right now, given the timing, given that we've got the 16th of June expiry that captures CPI and the FOMC, we are seeing a bearish divergence in terms of momentum. We wonder whether those catalysts, if they were to come out hawkish and take rates higher, are these high duration stocks that are not mega caps that are just printing cash for fun, like the likes of Microsoft, Google, etc. Are these high duration names susceptible to a correction if rates continue to charge higher? That's what we're thinking. So FOMC right now pricing a 25% for next week in terms of 25 bip hike, but pricing in 50% chance of a hike in July. And then also we're going to get the Fed dot plot next week. And if they do project higher rates and higher terminal rates, markets might need to reprice from where they currently are. And we think ARK is probably more vulnerable than the likes of NASDAQ, just because of the more risky, low quality names that make up that basket. On top of that, we're also seeing crypto markets trying to break a bit lower and decoupling from stocks, which is not going to play that well for ARK either. Okay, so we're thinking a short term 5 to 10% pullback in ARK is pretty possible if we get a hawkish outcome out of the two catalysts that are due next week. All right, so then what do we do about it? So looking at our strategy compass, we are obviously in buy put territory here, but we've got very positive vol carry in the 75th percentile, 10 vols positive. We have seen skew drop. We have seen term structure has a small inversion here because obviously for the FOMC. So what do we do? Well, we've actually homed in on a very short-term trade here because we don't think this week there's really much of a catalyst. So we think the catalysts are all for next week. So you like next Friday's expiry as a way to play a tactical pullback in ARK, given how stretched things are. And we're talking about a bit of a hit and run here, right? We're not going to hold on to a short trade in US tech for the medium term right now. We're just thinking things are overdone. If we get a bit of hawkish noise out of the FOMC next week, we could pull back and we'll take our money. So rather than just buying outright puts in ARK that expire next Friday, paying 40 plus vol, paying the theta between now and next Tuesday's catalyst, we actually like the idea of using a short dated calendar spread and actually selling this Friday's option slightly out of the money put to fund the puts for next week. All right, cool. Ask me as many questions as you want if this one's a bit complicated, but we're trying to simplify these quite complex concepts on a daily basis, and I'll catch you guys tomorrow. Thanks.